if you are someone who invests in mutual funds or stocks, then do not give this video a skip. Did you know that there is a legal way to help you reduce your tax liabilities? 31st March is just around the corner, and it is that time of the month when everybody tries their best to find ways to save on tax. And that is where tax loss harvesting comes into the picture. Tax loss harvesting is one of the easiest ways to reduce tax liability. It is completely legal and helps you save on income tax. I'm Neha Vashisht Mahajan from ET. Here's everything you need to know. First of all, I'd like to highlight that this is not tax evasion. Tax evasion involves fraudulently understating income or overstating expenses to avoid tax. So what is tax loss harvesting? It is the practice of selling a security that has incurred a loss in order to reduce or offset the capital gains that are subject to taxation. Now let's understand this with an example related to equity. For ease of understanding, we have assumed that STT and cess are not applicable. Coming to scenario 1, let's say that an individual earned 1 lakh rupees in short-term capital gains this year. He will have to pay 15% of the amount, that is 15,000 rupees as tax. Now coming to scenario 2, let's assume that in addition to the above, the individual already holds stocks with an unrealized loss of 60,000 rupees. Now what the investor can do is to sell these stocks at a loss and offset the capital gains of 1 lakh rupees. On net basis, he will now have capital gains of 40,000 rupees, that is 1 lakh minus 60,000. As a result, he would be required to pay 6,000 rupees as tax only, which is 15% of 40,000 rupees, meaning he saved 9,000 rupees in taxes, which is around 15,000 minus 6,000. Now this is called tax loss harvesting. You must be wondering that it doesn't make sense to sell at loss just to save taxes. Basically, there is no explicit regulation in India that disallows tax loss harvesting. Individuals can buy those same stocks and continue to hold them immediately after selling them at a loss. Now let us take a look at the same on LTCG, which is long-term capital gains. Scenario 1, let's assume that an individual has a long-term capital gain of 5 lakh rupees, which means he sold some stocks after holding it for more than a year. He will be required to pay a 10% tax on 4 lakh rupees, which is 5 lakh minus 1 lakh exemption, that is 40,000 rupees as tax. Scenario 2, suppose he has a few more stocks with an unrealized loss of 3 lakh rupees. In March, he sells these stocks and books losses. This unrealized loss now becomes a realized loss. He immediately buys the same stocks which he sold at the same price. He is now left with a realized capital gain of 2 lakh rupees, that is 5 lakh minus 3 lakh rupees. However, he has to pay a 10% tax only on 1 lakh because we deducted the exemption here, that means 2 lakh minus 1 lakh of the exemption. This tax amounts to 10,000 rupees. Therefore, he managed to save 30,000 in taxes, that is 40,000 minus 10,000, with the help of tax loss harvesting. Here are some things to note before going for tax loss harvesting. Number 1, please note that long-term capital losses can be offset only against long-term capital gains, but short-term capital losses can be offset with both long-term and short-term capital gains. Number 2, stocks are bought and sold according to the FIFO method, that is first in first out method. The stocks which are bought on an earlier date are sold first. This helps in determining the holding period, and capital gains tax is calculated accordingly. Number 3, stocks and mutual funds are both considered as equity when availing the exemption of 1 lakh rupees for LTCG taxation. While doing tax loss harvesting, one must look into the impact of exit load charged by mutual fund. Well, that is all for today. Stay tuned to ET Markets for more.